budding venture capitalist or an investor looking to deep dive into Indian startup ecosystem. In today's video, we'll break down the key investing principles which one should look for before making an investment decision. First one is founders and market fit. The foundation of any startup investment lies in founders and their market fit. A great team can pivot, adapt, and find success even when things don't go as planned. So one should always consider experience and expertise of the founders, whether the founders understand the market and they have the technical skills to execute. Vision and resilience. Visionary founders think long term, but they also need resilience to handle setbacks. Are they committed enough to weather the challenges and stay the course? A startup's success depends heavily on the founder's ability to align their expertise with the market need and deliver it. Without that alignment, even the best of the ideas can fail. Next up is scalability and market opportunity. We want to invest in businesses that can grow big and fast. So here's what you should look for. Market size. Is the problem the startup is solving significant enough to address a large and expanding market? A big market creates more room for growth. Business model scalability. Does the startup have a scalable business model? Can it grow revenue without a potential increase in its cost? So we should look for companies with repeatable, scalable processes. Competitive landscape. Is there enough room for the startup to compete and gain market share? Or is the space overcrowded with established players? So, scalability isn't just about rapid growth, it is about sustainable growth. The best opportunities are those where the product or service can expand quickly across geographies and customer segments with minimal friction. Now let's talk about traction and growth indicators. These are the proof points that show a startup is moving in the right direction. Key areas to evaluate in this section are customer adoption. Are users actively engaging with the product? One should look for growing customer bases and positive user feedback. Revenue growth. Is the startup generating revenue and is the revenue growing steadily? So one should watch for signs of consistent revenue growth, especially in recurring business models like software as a service business. Moving on, unit economics. Are the unit economics sustainable? Are the customer acquisition costs lower than the customer lifetime value? Which means that whether the company that is spending per customer is earning more from each customer or not. Startups with healthy unit economics show that they can scale profitably. Before you write that check, rigorous due diligence is must. Dig deep into the startup fundamentals. One should see financial health, where we review the financial statements, burn rate, runway, and funding needs. So are the numbers realistic and well managed? Business model and revenue stream. Is there a clear and diversified path to monetization? One should assess whether revenue model is proven and scalable. Then risk factors. Identifying potential risk is very important, like competitive threats, regulatory hurdles, or dependency on key clients. This analysis can save from any unpleasant surprises later on. Finally, one should look at and we should talk about diversification and risk management. Even the best investors don't put all their eggs in one basket. Here's why. Because one should see stage and sector diversification. Spread your investments across different industries and stages, early stage, growth stage, or late stage startups. This helps in balancing high risk reward bets with more stable opportunities. Portfolio strategy. A diversified portfolio increases your chances of having a big winner while reducing exposure to any single venture's failure. So diversification isn't just a safety net, it's a strategy to maximize returns by exploring multiple growth avenues. Thank you. For more such engaging and important content on investing in startups, please subscribe to our channel. Thank you.